Hi, today's topic is share valuations. We are going to discuss the difference between asset backing and market trading price. Hopefully we'll show you how to value your shares before you dive in. People buy shares for all sorts of reasons. Blue chip, speculative, growth, return, dividends, franking, etc. And we do not want to change any of those motivations. We simply want you to know the substance of the company you are about to invest in or depart from. Let's look at an example that should explain what goes on and hopefully answer why. Now, finding the share price. If you find that the asset backing of a share is $1.40 and the shares are trading at $1.59, there would be some cause for concern. In other words, if you should always buy any asset at or around the market line. But if you find you're paying a premium or a high cost above that, then you should consider your investment decision. So now, how do we find the asset backing value of any company share? Well, all businesses consist of either 2, 3, 4 or 5 components. Service companies do not have stock and so they have less components. To value any business, simply find the component values and show all on the business valuation worksheet. Stock component is found in the balance sheet, but must be adjusted in line with business cycles. And to give you an example, say you had a bakery, you've got lots of stock in the morning, but by the afternoon you have no stock. So it is best to use average stock ratios. Plant and equipment is also found in the balance sheet, but at a written down value. Now this value has nothing to do with market values. Depreciation schedules are also misleading because not all of the equipment and vehicles are recorded. Both of these items are covered in the book. Property is recorded in the balance sheet at historic cost, which is very misleading. Property may have been purchased 5 or 10 years ago, and the price recorded in the balance sheet may be well below current market value. How to adjust property is outlined in my book. However, this item alone can make a very large hole in assessing values. That completes the tangible assets. Now for the intangible. Goodwill is probably the most misunderstood, but my book outlines a new methodology of assessing goodwill value quickly, and it can be used to put you within close proximity of market value within minutes. You do not have to wait until the preparation of financial accounts. It can be used any hour of the day and any month. It is far superior to the old way. Now, IP assets or purchased goodwill will sometimes appear in balance sheets and can be very misleading. In most cases, purchased goodwill will appear as a large figure that is not market related and may never be recouped, which means it is an unsupported number. This is covered in the book and tells you how to adjust to market. This is a learned process, but it teaches you to seek truth, not support a lie. Now the final problem, and it is a big one, is that of liabilities. They may be financial, they may be legal, or they may be external, warranties, contamination, etc. Once you have the total unencumbered value, you then need to deduct liabilities. One of the major problems with balance sheets is the lack of information available, e.g. the date, the term, the interest rates, the penalty rates, the disclosure of mortgagee details, whether the mortgagees are real or fudged. This is all covered in my book and it will allow you to make better decisions. Now, once you have all the relevant component values, The only requirement is find out the number of shares and simply divide the total amount of value by the number of shares issued. This will give you the asset-backed value per share, and then you can compare the current trading price as per the original diagram. Many investors buy shares purely on rumours, and while stock values rise and fall, the company generally retains its balance sheet values regardless of share market activity. And where does the share market fit in the Australian business market? It represents only 0.01% of all companies in Australia. And of the 2,000 odd companies listed on the ASX, probably only 1/3 are well positioned, and the other 1,400 or so, or the other 2/3, are in a difficult circumstance, as is the case in America. This brings me to another point worth noting, and that is debt levels or liabilities. If the debt levels are more than 50% of capitalised value, the company will have limited future comparative advantages. And it would pay to see my video on acquisitions and mergers. In other words, if they have chosen a path of debt rather than shareholder support, it is a clear indication that the value of the shares, of your shares in the future, are suspect. Now for the wider private market. Whenever you see companies in debt, always seek to erode their industry or customer base or revenue streams by providing better goods or services. That concludes today's presentation, and all of the above can be found in my book on Business Valuation Explained. Thank you for listening.